What is the real reason stock prices rise over time? It's probably not what you expect. Hi everybody, my name is Cody Koch. Welcome to the channel where we talk about advanced trading, investing, and business concepts. So there's a lot of reasons that are usually used to explain why the stock market goes up over time. Things like technological advancements, populations growth, better economies, and so forth. But actually, when you really study the data, you will find that's not true at all. So here's a chart of the S&P 500 going back to 1872. This is a monthly chart to be exact, and you can see it all the way back here in 1871, I guess technically, and this is what it is today. Now this is a chart of the United States M2 money supply, which is a measure of how much dollars are floating around the economy. And now this is the S&P 500 compared to the United States M2 money supply. And as you can see, the differences between the two of them, since the M2 money supply was first being tracked in the 1950s, the difference between the two is almost non-existent at all. You can see the M2 money supply has actually gone up 7,460% compared to the S&P 500 going up 7,345%. A difference of really just about 120% between the two of them, which is tiny considering we're talking about 7 or so thousand percentile. So this is very fascinating to me. The reason I want to talk about this is because you're either going to have to learn to use this to your advantage, or you will be destroyed by it. There's no middle ground. As they say, you're either green and growing or you're brown and dying. And in this case, you don't really have a choice. You have to begin to understand how the money supply really works and what it's really affecting throughout the economy. This is probably the most important chart I'll show you in this entire video. This is the S&P 500 in terms of the US M2 money supply. So in a manner of speaking, what I've done is shown what the S&P 500 would look like if the money supply was constant. In other words, we didn't have a constant stream of new US dollars created all the time. And as you can see here, going back to 1959 all the way to today, the price between the two of them are very, very close. They're off by just a tiny fraction. And that is interesting because you can see as it fell all the way down here in 1982. This is interesting because they were shrinking the money supply quite dramatically in the late 70s and early 80s. As you can see, it kind of was obviously affecting something with the S&P 500. In 1980, in fact, the Fed interest rates hit about 19.5%, something like that. Highest interest rates we've had in the last several decades. And then this is, of course, the 1999-2000 dot-com boom, where they had created a lot of dollars during this time. It created a big boom in the S&P 500. But that boom, of course, the bloom off the boom faded, of course, and it crashed. And all the way down to 2008. Let's see what this one is. This is 2002, which was a little bit of a bust year. But 2008, obviously, is when things were hit really bad and the crash back then. And so you can see that the money supply expansion and contraction does, in fact, significantly affect the S&P 500. But beyond just the supply of dollars, but overall, you can tell that if the money supply were constant, this whole thing would actually stay pretty much the same over time. So I'm asked, how would you actually make money in the stock market if the money supply was constant and so therefore prices never rose, the stock prices never rose? Well, the answer to that is the dividends, a combination of the dividends of those companies, as well as the reinvestment, the retained earnings of successful companies would in fact grow the individual stock prices. So for example, as Microsoft was making its rise, that stock would absolutely have risen because it was gaining wealth, it was producing a lot of cash flow, it was growing wealthier and wealthier. On the other hand, many other companies were declining at the same time on the S&P 500 and the Russell 2000 and the Dow Jones 30, etc. Some are rising while others are falling. So proper selection of your investment strategies and different things you would do, you could choose companies that were performing better than others. And in that respect, you could enjoy stock prices rising, but your primary goal would be to enjoy the dividends and the cash flow, either retained in the business or sent to you in the form of dividends. That would be your primary goal in the stock market. Again, if the money supply was constant. So next I want to show the S&P in terms of gold. Gold has been used as money for thousands of years, and it's kind of instructive to be able to observe what may actually have happened over time. Now we're going all the way back to 1889 on this chart. Again, this is TradingView. S&P 500 in terms of gold, you can see this interesting spike. This was in 1929 when we had the big boom and subsequent bust that followed. This began to rise, well, quite substantially, but it started to pick up in the 1955, which was the beginning of the Vietnam War. All governments print money during wars, by the way, including the United States government. So major wars, a lot of capital is hitting the market, a lot of freshly printed money is usually hitting the market, and that's part of the reason you see these booms during wars. You see this big crash that occurred by 1975, which was the end of the Vietnam War. The money supply had started to be shrunk dramatically, or at least the growth in the money supply had to be slowed because inflation was out of control, and they started to raise interest rates quite a bit in order to save the dollar in terms of its value around the world. And so by 1980, it's interesting that in 1980, this was the lowest point in terms of gold that the S&P ever reached. And that was the year that interest rates got their all-time high. The Fed funds rate was at 19-something%. I know a lot of mortgages, home mortgages back then were well in the 20 percentiles. So it's really interesting kind of world, very different than what we have today. So after that, the money supply, they began to expand the money supply, expanded it very dramatically in the late 90s up to the 2000 dot-com, 1999 big boom period. And then of course, gold ended up picking back up. Its price started to rise. The S&P 500 came down a little bit, but mostly gold caught up with all that money printing until we got down to 2011. Here it's its low, and then right now it's roughly in this range. Now I want to show you that gold has slowly crept up over the last 100 or so years, in 120, 130 years, I should say. The reason that is because the supply of gold has actually risen. Similar to the money supply in terms of dollars rising causes the S&P to slowly creep up, the gold supply has actually risen over that time. In fact, total gold ever mined in human history has doubled since the 1960s. So since roughly in this range, we've doubled our money supply, our gold supply, I should say. So you could almost argue that one could see the S&P 500 maybe going to double this at some point in the future, doubling what this was, simply because the supply of gold has doubled in that period. So you're kind of pricing things in a asset that's also slowly becoming higher and higher supply, very similar to the dollar, but not nearly as fast as the US dollar has grown in supply. So it's kind of an interesting and instructive thing. I'm going to show you a few other things. This is the S&P in terms of palladium. You can see it's actually declined over these years. 1997 was when palladium began. You can see it's actually had a decline this whole period, and that's mostly because palladium has gone up dramatically faster than the S&P 500 has over that period. And in fact, palladium has outgrown the growth in the M2 money supply, so it's all connected. Okay, the last thing I want to show you is the S&P 500 in terms of West Texas oil prices. Now this goes back to 1881. So way back in the day. And as you can see, the supply of oil has risen over time, of course, because we're producing way more oil than we did in the 1880s. You can actually see the S&P 500 spiking significantly in terms of oil. This makes sense. In 1999, oil hit an inflation-adjusted all-time low. So that would mean the S&P was obviously rising quite dramatically compared to oil, and you can see it crash back down to essentially levels going back in 2011 that it's been at for 100-something years. And then it had another, in this case, when oil almost completely crashed down to pennies per barrel, and technically I guess for a moment it was negative per barrel, which was crazy. You can see that it hit that and then it's come back down to more normal-ish levels since then. So I just want to point this out. I find this very fun and interesting. It's very instructive. You can kind of see how things compare in terms of how things move in terms of other things, and it's kind of a very fun and instructive process. Now, so you could actually utilize a lot of this in terms of spread trading, where you could buy one asset and simultaneously short an equivalent amount of another asset. You can actually create spread trades, which end up looking a little bit like these, actually look a lot like these charts right here, which is very interesting and creates a whole different environment to create uncorrelated trading systems and so on and so forth. So I just wanted to show all this to everybody. I thought this was kind of fun and amusing and interesting. Okay, that's what I have today. If you enjoyed this video, please like and subscribe and leave a comment below if you have any questions, and I'll try to get to it in a future video. Thank you for watching.